Welcome to this presentation on portfolio construction using mFunds. Managed funds are playing a greater role in predominantly share-dominated portfolios. Share investing has always been both an art and a skill. Pick the right stock at the right time and investment returns can flourish. Now widen that investment palette and not only can returns flourish, but the ride can be smoothed out as well. Almost 1/3 of self-managed super fund trustees who are considering investing in global equities now prefer managed funds. That's according to a new report by research house Investment Trends. Now that's higher than direct shares, exchange-traded funds, and listed investment companies or LICs. It suggests that there's a sea change occurring among self-managed super funds, which have historically shown a preference for concentrated direct share portfolios, residential property, and bank deposits. The ASX mFund settlement service, which was launched last year, allows investors to trade unlisted managed funds through their broker. It's a low-cost, efficient platform which makes buying units in an unlisted managed fund as simple as buying shares in a blue-chip stock. The statistics, as can be seen here, show the popularity in using mFunds to gain international exposure. Almost 1/3 of self-managed super fund trustees who are looking to gain international exposure would prefer to do so using managed funds. When we look at the statistics, this is what they show. A Financial Services Council last year found that 15% of self-managed super funds are looking to invest in international shares. It's also a trend that we're seeing here at Bell Direct. Why? Let's have a look at the next slide. Naturally, it has to do with risk and return. Let's start by having a look at return. While the Australian share market has returned a very healthy 10% over the last 1 year, some of our international counterparts have fared much better. If we have a look in China, the Shanghai Composite is up by 93%. Over in Japan, the Nikkei 225 has managed a gain of 43%, and in Germany, the DAX is up by 33%. So by gaining international exposure, we also would have gained some pretty stellar returns. And that's not just over the short term. As you can see from this slide, even over the long term, we've seen quite a variability in the types of returns from different markets. So while investors have enjoyed some recent strong gains on the Australian market, I guess there are a lot of concerns that our market may be slightly overvalued amid a weakening economy. By contrast, some of our international peers are seeing a strong recovery in their underlying economy and their share markets as well. But what it does show is that different markets do perform differently at different times, and you can get the benefits of diversification through gaining international exposure. mFunds and managed fund exposure has recently been very popular because of not only the diversification effects that international exposure can offer, but also the higher returns that it has recently offered. How can you decide to gain exposure with mFunds? First of all, you can go to the ASX website and do a search on what you are looking for. Over here, we've done a search on emerging markets, and you can see that we have had 2 results in our search. One is the Aberdeen Emerging Opportunities Fund, which has managed a return of 24%. The other is the Equity Emerging Markets Fund, which has managed a return of 23.6%. So once you've decided on international exposure, it's very easy to do a search using the ASX website on which assets, which markets you'd like exposure to. But of course, gaining international exposure and using mFunds isn't all about just returns. It's all about reducing risk as well. And in reducing risk, there are a few important principles involved. First of all, to get the benefits of diversification, choose assets which do not tend to move together. Negatively correlated assets reduce more risk. For example, if you owned 4 of the big banks, you would be diversified, but you wouldn't be well diversified because the big four banks tend to move together. To get the maximum benefits of diversification, the key is to choose assets that do not move together. The great thing is if you had two different assets which are expected to return around the same, 50% in each would result in around about the same returns, but should lower risks. So it's not all about returns. Diversification is about having different investments that do not move together. The advantage is the reduction of risk through lower volatility returns. A well-diversified portfolio can produce more efficient returns for the same level of risk. To give you an idea of how some of the markets we've been looking at correlate to each other, I've just posted up the correlation numbers for the last 2 years between these markets. So you can see that an Australian versus a US share portfolio has a very low correlation level, which means you would get a lot of benefits from diversification into both of these assets. While we've had a look on a risk and return basis on why you might want to diversify using mFunds, there's also some key macro themes to keep in mind. And first of all, bond yields are driving returns, with negative interest rates in much of the globe, including Sweden, Denmark, Switzerland, the European Central Bank deposit rates, as well as Japan. The hunt for yield is very strong, and this trend is likely to continue. Portfolios which are short gold, government bonds, and emerging markets have been absolutely hammered, whereas portfolios which are long small caps, long the market, long tech stocks, and long bank stocks have flourished. Now, looking at what is likely to occur, markets with stimulus and quantitative easing have outperformed and will probably continue to outperform, and that's really why we're overweight countries like Europe as well as Japan, which are undertaking quite aggressive quantitative easing, and we're underweight the US. We like the US recovery at the moment, but the fact that quantitative easing has come to an end means that we're likely to see countries like Europe and Japanese markets outperform. So don't fight the central banks, and in this, the Japanese and the European stock markets are winners at the moment. These stock markets are likely to outperform. If you are new to Bell Direct, you'll need to go to the Bell Direct website and sign up. It's free and you can do it mostly online. If you're an existing Bell Direct client, well, you can start trading mFunds straight away. Just click here. If you'd like more information, please go to the Bell Direct website. It's an exciting new world which allows individual investors to gain the benefits of greater diversification and a range of different assets. What we've found for Australian investors is a combination of the falling Australian dollar and superior international returns have meant that portfolios perform more efficiently, as well as providing greater returns. So in this presentation, I wanted to run through a little bit on how you can use mFunds to not only enhance returns in portfolios, but also to reduce risk. It's an exciting development for individual investors as well as self-managed super funds. And what we have found at Bell Direct is that we are seeing an increase in popularity of gaining international exposure through something like a managed fund, and mFunds allows easier access in order to do that. I wish you all the best in your investing future and hope that this presentation has been of value to you.